Okay. Robert?
I had another question.
Yeah.
What would be the best dividend paying index fund to invest in right now?
Yeah, so there's two dividend ETFs, which ETF and index funds are very, very similar.
Mm-hmm.
The two that I like and I recommend to people if they want to check it out and do the
London.
research is VYM. I'll throw that in the chat. VYM, and then VIG. So I just threw those in the chat, the stock tickers, VYM and VIG. So the difference between the two is VYM is ETF geared more towards higher yield. And then VIG is geared more towards dividend growth. So VYM is a higher yield, VIG is more of dividend growth. Those are two that I really like. And if you're looking for dividends, those are two
Thank you.
great. Yep. Neymar.
Hey, sorry, I'm using my son's account.
Okay.
So I just have a question. So, I don't know, to open up a Roth IRA or a traditional IRA, is there like a income limit to that, like to whether I can open one or not?
Yeah, so there's no like minimum you have to have to open one. So it's not like you have to make, X amount of dollars per year to open one. All you have to open a Roth IRA or all you have to have to open one is what's called taxable income or earned income, which basically, like, if you work a 9 to 5 or you work at a job that they take the taxes out, that will qualify. But there is no like minimum to invest in a Roth IRA or a traditional IRA. But for Roth IRAs, there are maximum contributions. Maximum income limits. So I don't know off the top of my head, but it's like 130,000 ish for a single filer in the year. If you earn more than that, you're not allowed to invest into a Roth IRA. Now, there are ways to get around that, which if you're in that situation, we can talk about that. But it's 130,000 ish. I don't know the top of my head, but it's around 130,000 is the maximum you can earn in a year to invest in a Roth IRA. But there's no minimums.
Okay, so I make more than 130,000.
Okay,
so
that's fine.
What would be the alternative?
Yeah, so if you want to send me, so I haven't yet done this. I probably will either this year or next year, but I'll have to. There's a thing you can do called a backdoor Roth IRA. Essentially, what that is you open up a traditional IRA and then you transfer it into a Roth IRA and you pay the taxes now from the transfer, and then you're inside a Roth, so you have like the benefits of a Roth IRA. If you want to send me a message on social media, on Twitter or Instagram, I can get you connected to someone who just did it this past year that I trust, that will be able to like guide you through the steps that he took to be able to do that.
So like my previous employer, I worked for the county, and so they didn't take out, I don't know what, like, I guess the federal taxes, or I don't know what they did, but they were able to open up a Charles Schwab account for me, a traditional IRA. So what happens to that money if I'm already, like, they opened it, but I just haven't called to see, like, and do anything with that money that's in there. But what happens if I'm over, since I'm over the limit, can I still, take that money out or keep it there, or like what would happen with that? Do you know?
Yeah, so if it's in a traditional IRA, then you wouldn't have to. There's no limits with a traditional IRA. If you want to like transfer it to a Roth IRA, you could. You would just have to pay the taxes on it to transfer it to the Roth, because the Roth, with the way the Roth is set up with taxes. So you would just have to. I mean, I don't know what's in there, but it wouldn't be based like that money. What's in there wouldn't be based off what you earn. It would just be, if you wanted to move it, it wouldn't be based off what you earn. That's just all from what's inside that account.
Okay. All right. Thank you. I'll send you a message.
Yeah. Okay. Perfect. Siobhan, or sorry if I pronounce any names wrong.
Can you hear me? Hello?
Yes.
Okay. I have a question regarding dividends.
Okay.
there are a few questions, but I'll come in and out. When evaluating a stock for dividends, there's a lot of information out there,
Mhm.
but in regards to ratios, I haven't been able to find anything that give me parameters for the ratios, like what is the minimum or maximum payout ratio that a stock should have or a company should have, or what PE ratios, like what are the parameters that I should be looking for when evaluating these stocks?
Yeah, great question. So there's a couple. So it'll all kind of differ amongst the industry, and what I mean by that is, like, if you're looking at a REIT, so example, the stock O that a lot of people probably, you've probably seen people talking about, where they pay the monthly dividend. Since
Mhm.
they're a REIT, they have to by law, legally have to pay out at least 90% of their earnings. So essentially, their payout ratio is going to look really big because it's like over 90, which, is for most stocks is not good, but that's just because it's a REIT. Um, but when it comes to parameters, it's kind of hard to say just because it fluctuates so much year to year. But I would probably say off the top of my, just what I like to look for is anything like around 50 to 70%, is kind of pushing it towards the higher end of a payout ratio. Because you think about it, if a company is going to pay out, 80 or 90% of their income, that could be scary because there's possibly no growth of that dividend.
Mhm.
So that's kind of just some parameters. If you and I don't want to just keep relying on this, but to be able to give you a great answer with more parameters, when I have time to sit down and like type it out, is if you send me a message, I can, like, at least have the second to, sit down and type it out and get my thoughts on, because I don't, off the top of my head, I don't have like each one laid out.
Okay.
But if you want to send me a message, I can, like, send you some parameters that you should be looking for, just because it kind of differs between industries as well. So I don't want to, what might work in, tech or something might not be great for consumer staples, just because they're really different sectors.
Okay, is it okay if I do that for the other questions that I have? If I just kind of send you, I have like 6 questions that I need help with. Is
Mhm.
it okay if I just send them to you so I don't take up a lot of time here?
Yeah, you're more than welcome. Or if you just want to lower your hand and re-raise it, I mean, like I said, I'll be here probably for another 45 minutes. So I don't mind answering your questions now, without, obviously being respectful of other people, but getting your questions answered now if we have time.
Yeah. No, I think for time it'll be best if I just write them out and send them to you.
Yeah, that works too. That works too. And I'll get back to you tonight or tomorrow.
Okay, perfect. Thank you.
Yep. Michael.
Yes, I'm here.
Okay.
I had a question. So when you're looking, you're more on the long term, like holding side of things, and I know that the fundamental analysis, from listening in to you before, was like, you know mostly what you concentrate on. I was wondering, like, what role does technical analysis play when you're looking for, if at all, when you're looking for a long term hold?
Yeah, great question. So for me, when it comes to, like you mentioned, I do a lot of fundamental, just because I plan to hold it for, ever, essentially, that stock. But technical analysis does come in just a little bit less about like when to buy, and more just kind of looking at different ratios, like I was mentioning earlier. Looking at just a couple different ratios to see where the company stands, on that side of the things. Because, you can look at a company, you can say, wow, they have great leadership, they're doing great things with the company, but their books might look bad, right? Or like this, they might be paying over 100% payout ratio, or whatever the case is. You kind of have to couple the two. But for me, I probably do like 70 to 80% fundamental with that technical on the side, because two is like, you can look at the technicals, but you don't want to get, what I like to say, analysis paralysis, where you're looking at it so much that you're just like, because you can always find the bad, right? There's always something going to be wrong, and probably going to be wrong in that book, or when you're looking at their financials or technical analysis. So you kind of, I like to just weigh a little bit more fundamental, because, like, for example, if you look at Tesla, right? You look at Tesla like 2 years ago, right? They had turned like one profitable quarter in the history of the company. And, you know, so it was like their books weren't looking good. You looked at the technical analysis, you would have not invested in Tesla. But if you look at fundamental, like who's leading it, what's the, you know, how is electrical cars and stuff like that playing a factor in the country and worldwide. And so that's a case where, you know, you do too much technical, you might miss the boat because, you know, it might not look good right now, but the future outlook of that company could look great. So,
Gotcha.
so I like to do a little bit more fundamental, just because I don't know, that's just what I like to do. Doesn't mean it's right, but that's just what I prefer.
Okay, and I got one more quick question for you.
Yeah, go
if
ahead.
that's okay. I was talking to a friend earlier today, and we were talking about, having the importance of having the Roth IRA, and he was talking to somebody else, before he talked to me, and they were saying like, oh, you should focus on paying down your student loans right now while they're, the interest is, at a stop, before, getting the Roth IRA. And I told him, it'd be better to open up, even if you're going to pay on your loans, to like still have the Roth IRA. I just wanted your thoughts on that.
Yeah. I mean, that's the forever debate in finance, is do I pay off debt or do I invest? And, some people will say, like, for example, Dave Ramsey, if you've heard of him, he'll say, pay off all your debt before you invest. And I've seen other people say, well, I invested as I paid off my debt. And yeah, my debt took longer to pay off, but I had that snowball of investments working for me. I'm kind of in the middle. And the idea that, number one, what is the interest rate of that debt? I know the student loans, the interest rates are frozen right now, but just in the case that you don't get them paid off by the time, that they restart the interest, what is the interest rate of the debt? And number two is just is your motive to pay off that debt? Because if you say, yeah, well, I'm going to invest as well, that's great. But if you do too much investing, and not paying off your debts, that will, the interest rate of the debts will accumulate and compound the other way than the way you want it to.
Right.
So I'm more in the middle of, it's person to person. I see it. There's no like blanket, you do this or, I do this or whatever. For me, I lean a little bit more towards paying off the debt, just because when my money comes into my account, I don't like to owe people, a piece of that.
Right.
I want to pay, what be it working for me. But also, I know the importance of starting that compound, that snowball early, as early as you can in the Roth. So, maybe it's like 80% of the money that your friend was going to, or, the person you're talking to, that they were going to use to pay off the debt. They use to pay off the debt, and they use the other 20% to invest, right? Or maybe it's 60-40 or, 50-50 or whatever it is. I think, again, that depends on the interest rate of the loans. But I think that you can find that middle ground that works best for each person to be able to pay off their loans as fast as they can, while also getting that snowball working for you on the other side. So I know I didn't really give you a definitive answer, just because it's not, it's very like dependent upon each person. Yeah.
Right.
But did I give you some good insight? I mean, I can keep going on if that didn't. But.
Yes, that's good. I appreciate that.
Okay, cool. Anything else?
No, I'm good.
All right. Thanks, Michael.
Thank you.
Kendall.
Hey, yeah,
Hello.
I had a quick question about like how to allocate or weight your investments. Like if you're breaking it up into IT or consumer discretionary, healthcare, REITs, whatever, like how do you figure out weighting your portfolio?
Yeah. So for me, I have a couple of portfolios, just to kind of lay it out here. I have my Roth is 100% in index funds and ETFs. I have 3 total. So one of them is VTSAX, which I was talking about earlier, which is a total US market, and that's 50% of my Roth. And then I have 25% in international market and 25% in a tech focused fund. But when it comes to my individual stocks, which is a different portfolio I have, I break it down from how I see it is I break it down more for me on my like risk tolerance. So since I'm younger, I'm a little bit more heavy into tech, just because, yeah, tech's great. Sorry, there's a question. I use VGT. I'll put it in the chat for my Roth VGT. But I break it a little bit more into tech just because I have that age to be able to, hopefully if things go bad in tech, they'll be recovered by the time, I need the money. So it kind of boils down to personal preference. I know some people that are heavier into, REITs because they like REITs and they understand REITs and they think they can get they have gotten a better deal when they bought that REIT or that stock. So it kind of just depends on your risk tolerance, when you need that money, what kind of your strategy is. Are you going for more growth? Are you going for more income or value stocks or whatever it may be? So it kind of, and I really hate to not give you a direct answer, but it really just kind of depends on your strategy and kind of what you're looking for. And your risk tolerance is a big one as well.
Okay, yeah, I'm looking mainly for my Roth. My brokerage, I kind of have figured out, but just for like that long term, like what's going to be like stable and consistent.
Yeah, and in my, like I told you at the beginning of the question, my Roth is 50%. So basically majority of compared to the other two in total U.S. stock market. And like I was saying at the beginning of the call, is that's I'm in my 20s, so my Roth isn't going to get touched till I'm 60 at the earliest. So
Right, same.
what I'm doing, I'm just putting it into that VTSAX total U.S. stock market, and in 40 years. It's I max it out at the beginning of the year 6,000, and I don't even open my Roth barely for the rest of the year in my Roth account, but just because I put in there, and essentially what you're doing is, or what I'm doing is just saying, okay, is America as a economy going to be further along in 40 years than we are today? That's kind of how I do my Roth, and then I go a little bit more risky in the sense in my other accounts that are not in my Roth.
Gotcha. And then real fast, just to kind of piggyback off that, index fund versus ETFs, is the real, like, I know there's some differences on like the buy-in amount, and then like I guess I guess that's really it in my eyes, is like the buy-in amount, where like ETF you just pay the price that it costs to get a share, versus the ETF is like a 3,000 minimum sometimes.
Yeah.
But other than that, like most of them have corresponding ETFs and index funds. So is there really a difference on whether you choose ETF versus index fund?
So you are correct in what everything you said. So that's true. There really isn't. There is two minor differences. One is with index funds, and you might have just not mentioned this, but it's fine. And I'm saying this for the rest of the people listening. The index funds, when you buy an index fund, say tomorrow you at noon, you're like, okay, I want to put $100 into an index fund or whatever. The buy won't occur until after the market's closed, when the index fund is priced. That really doesn't mean anything, because you're not trying to like trade it or like make a quick buck on it just because it's an index fund. But other than that, there are like very minor tax or it's in a Roth, so it really does. If you do this in your Roth, it really doesn't matter. But if it's not in a Roth, there are like minor tax differences between like distributions versus dividends from an index fund versus an ETF. But I don't know too much on it to say like how much, but it's not a huge factor. I think it's very minimal. I need to do some more research on that. But that's really the only like main differences. I mean, most of them are interchangeable, like, and you said you look up an index fund and it usually has an equivalent ETF, and there's really, like I said, not a huge difference to like, that's going to cost you millions of dollars in fees, or hundreds of $1,000s in fees if you went ETF versus index fund.
Gotcha. Okay, I appreciate it.
Yep. Thank you. Sharon.
Hi again.
Hello.
So I was listening to you talk about you being more risky because you're in your 20s. I'm in my mid 30s, and like I said, I'm just getting started with everything with the Roth and whatever the case may be. I find myself pausing because I'm just really not sure, like I'm not sure where to go. So I definitely want to take care of retirement. I'm definitely late in the game with the Roth IRA and everything like that. So I want to take care of my retirement, but I also find myself in a position where I need my money to flip like quickly as well, because I have a lot of expenses coming up this year. Like I need to move. There's a couple of things happening where I need the money. So I'm just trying to figure out like, how can I set myself up in a position where I'm taking care of my retirement, because that's important, but I'm also getting some return sooner than later as well.
Yeah. So, and I'm saying this because I'm not asking you, I'm just saying this. I don't know your financial situation. But when it comes to retirement, and thinking about retirement is great. So with the Roth IRA, there is $6,000 per year that you're allowed. That's the maximum you can put into it. And so, there we go. So there's $6,000 is the maximum you can put into it. Again, I don't know your financial situation, nor am I going to ask. But if you're able to, say you want to invest $10,000 this year, right? Let's just say. What I would do, and this is just me. Again, I'm not going to tell you what you should do. This is all up to you. But if I was in your shoes, not knowing, again, this is all just not knowing anything about you. My first thought is put the $6,000 in the Roth, let that work for you in retirement while you don't have to worry about it. You just put it somewhere and let it go. And then with the money that's left over, that's where you can kind of be a little bit more risky. That way, one, you're thinking about retirement, you have that $6,000 working for you from, whatever age you are now in your 30s up until, 59 and a half or older. And you're able to, if you want that quick return, you want to be a little bit more risky. You have that money there to play. That way you're not using all that money to be risky, and running the possibility of losing money or losing, some of it. But you lose it and you don't have any money in retirement. This way you're worrying about retirement now. If you're able, you're focusing on retirement and still, using that kind of riskier play with that money that you have left over. And it doesn't have to be $6,000, maybe it's $3,000 in your Roth, whatever your situation is, whatever you're able to do, at least put something to work for you in the background for retirement, so that, even if the money you're being risky with doesn't work out, you still have money working for you.
Got it. Okay.
Does that make sense?
Yeah.
Okay.
Thank you.
Okay. Yep. Thank you. Lauren?
Hey, how are you?
I'm good. How are you?
Good. I came on kind of late, but
That's all right.
I've seen I pretty much make sure I hop on anytime that you're on, because I've gotten a lot of gems from you. So thank you again. But I just wanted to ask, like, for somebody like I just recently started getting into stocks and stock options. I'm wanting to trade like stock options kind of like day to day. I have a Webull account, but I'm not really sure if I should do Webull or TD Ameritrade. I was wondering if you knew in terms of fees and things like that, if you want to like make withdrawals, which one would be better for me?
Yeah. I don't do any trading or anything like that, so I don't know, and I don't use either of those. So I know I really hate to not be able to give you an answer, but I don't want to lie. Is there anyone in here that uses one or the other, or knows anything about the other that could help Lauren? Because I don't use either, so I don't want to speak on something incorrectly. If there's anyone that has anything, just feel free to like speak up. If you use one or the other, if you had any experiences with the other, that way we can hopefully help get an answer for Lauren. And if not, then I will find you an answer. If you want to send me a message on social media, on my Instagram or Twitter, and I'll get you an answer. I just don't have an answer because I don't use either, and I don't want to give you false information.
No, that's cool. I'll send you a message. Thank you, though. I appreciate it.
Yep. Thank you. Alpha.
Hey, can you hear me?
Yep, I can hear you.
Hey, so I was kind of curious about, I have a 401k through my employer, but I've been contemplating on opening a Roth IRA. Is there, not necessarily is there any benefit, but yeah, I guess I'm kind of wondering if it's worth it. If you already have a retirement account through your employer, is it worth it to kind of look into your own thing, like opening a Roth IRA or something like that? That's the first question. And the second question is, do you have any pointers or anything on maximizing your 401k? I was looking at it the other day, and I think it was telling me that like I maybe had like I was 80% maximized or something like that. And I was trying to figure out why that was the case. Like I think I'm putting in My employer matches me at 6%, and I think I'm putting in just about 6%. So I wasn't sure if there were anything else that I could be doing to maximize that account. So first question is it worth it to explore my own like a Roth IRA or something? And then the second one is how can I maximize the 401k that I have currently?
Yeah, great questions. Real quick, if anyone is just joined and you have any questions, raise your hand and I will call on you. That way we don't have anyone just shouting out. So just raise your hand if you have any questions and I'll get to you once I run through all the other ones. But great question. So number one, I'm going to say yes, because here's my thing. 401ks are great. However, let's say in the future you leave that company. There is, originally the 401k will stay with that company, and then you'll have to go through some paperwork to either roll it into your new company's 401k or roll it into a traditional IRA. So I always say get that Roth opened up. That's the first reason. Number one is to be able to have it no matter where it doesn't matter what jobs you change, whatever happens, it's your individual retirement account. So it's attached to you. So the 401k is it is attached to you, but your company is the one that's kind of over it, and kind of directs certain things, what you can and can't invest in. So like if you went to your 401k, you probably more than likely, can only invest in certain funds or stocks, maybe stocks, but usually just funds that your company decides on. And within those funds, they usually charge high expense ratios. Not always, but just something to look at. So I always say, if you're able, and you can afford it financially, to open up a Roth IRA. One, to be able to have it always under you, like I said, but number two, the tax benefit of a Roth IRA is amazing. Basically what it is you pay the taxes now, and when you pay the taxes, as long as you keep that money inside of that account, inside that Roth IRA, you won't pay taxes every single year. No matter if you get dividends or whatever, you won't pay taxes. You can sell them and buy something else, you won't pay taxes. And when you reach 59 and a half and older, you don't pay taxes on it ever at withdrawal. So basically you pay taxes one time, and then for moving forward, you never pay taxes on the Roth IRA again. So that's kind of my long-winded answer to question one. Is yes, I would open up a Roth IRA if you financially are able to, just because you kind of have it under your own wing more than a 401k. And number two, the tax benefits of it, I think are second to none with the Roth IRA. The second question about the 401k maximizing, if you're getting your company match, then essentially you're maxing your 401k out. Well, yeah, you can put in the 19,500, but you're maxing what you get from your company from the match. So with your question, there's really nothing you can do to max out that benefit from the company, as long as you're taking your 6%, or you're putting in at least 6, so you're getting the 6. There's nothing more you can do to get more money, other than if you just wanted to put more money into the 401k, it just wouldn't be matched. So there's really nothing you can do to like maximize it more. And you said something about the 80%. I would just double check you're at 6% in your contributions. You might be like at 5.5% or something. That's why it's only giving you 80%. But that might not be the case, but that's the only reason why I would think that would possibly be the case. But those are kind of my two long-winded questions. Did I get them both? Are you still confused? I want to make sure you got them all.
No, thank you so much. Appreciate you.
Yeah, thank you. Are there any more questions? I know there's about 80 people in here, but I don't want to get off here with people not having any questions. So if you have any questions, just raise your hand. And if you don't, feel comfortable raising your hand and don't want to talking, completely fine. I'm going to throw my social media handle in the chat, and you can send me a message on there, on Instagram or Twitter. And I reply to people all the day. I love this stuff. So you can send me a message on there, or it doesn't have to be from here. You can think about a question in 2 weeks, shoot me a message and I'll get back to you. Okay. There's a question in the chat. Hand raising is working. Okay. My question is, what are your best stocks to put in Roth? So for me in my Roth IRA, I only do index funds and ETFs, just because, and this is my thinking. My thinking is I was saying earlier, I'm in my 20s. So, and with the $6,000 limit, right, I'm investing more than $6,000 per year. So in that Roth IRA, I just want to kind of set it and forget it until age 59 and a half or older. So with that being said, I just put it in my Roth IRA. I put it in VTSAX, which is the total US stock market. I put a little bit of the money in VTIAX, which is the total international stock market. And then I put some of that money in VGT, which is a tech focused ETF. Majority of that money is in VTSAX, 50% of it. But that's what I do for my Roth, and that's what and you know, again, legally I can't recommend anything, nor am I going to recommend anything. Always do your own research, but that's what I do in my Roth. Just because you know, I'm investing more than 6,000, so I put that 6,000 there in those accounts, and they're broad market. So basically, my second thought with that is, you know, if I put it in VTSAX, which is a total U.S. stock market, I'm essentially investing in the future of the United States economy as a whole. So that's kind of what my thoughts are with Roth IRA. Is just kind of, since where I am, again, this is all personal. It's called personal finance for a reason. But for me, that's what I do, and I think, you know, works best for me. Can you put those ETFs in the chat? Yes. I'm not sure. I think. Okay. Yeah, I'll put the what I have in my Roth in the chat. And if there's any questions, always raise your hand. That's all it is tonight is just a Q&A. I wanted to come on here. Yeah, Alpha.
Sorry, one more
No,
question.
you're good. No, you're good.
So, in terms of opening a Roth IRA, is there like do you have any recommendations on like who to go to? Like I've had some people reach out that are like, I think they maybe get a commission off of like, you know, selling the person or whatever, but and that's always been kind of shady to me. So I haven't really had the opportunity to find like some golden opportunity or company or whatever that I can sign up with.
Yeah, so I would just do Vanguard. Vanguard's a little tougher in the sense that their like user interface is kind of outdated, their website, but I like Vanguard. I like Fidelity and TD Ameritrade or Charles Schwab. Any of those for Roth IRAs is just a really good, in my eyes, good option. And I'm not, like you said, I'm not financially tied to any of those. I'm just saying those because I use them and I like them. So Vanguard, Fidelity, Charles Schwab, TD Ameritrade. I haven't used TD Ameritrade, but I hear good things. So I don't know about that specifically, but I hear really good things about them. But the other three I have used and I do like.
Perfect. Thank you. I already have a TD Ameritrade account, so that's great.
Yeah, and you can open. Yeah, I mean, you might know this, but you can open up within the same login. You should be able to. At least it's how it works at Fidelity. Within the same login, you can have like two account types. You can have like a taxable and a Roth IRA, and it's all in one place.
Awesome.
Yeah, you should be.
Thank you.
I don't know that for certain on TD, but for that's how it works at Fidelity. So
Great. Thank you.
Yep. Thank you, Kendall.
Hey, kind of piggybacking off that question. I've been looking a lot into M1 Finance. I'm not sure if you're familiar with them, but they do these like pie chart where you can kind of build a pie and then set the percentage for each piece of the pie, and that's like the different ETFs or index funds or whatever that you want to invest in. But I kind of hesitate because that firm isn't pushed as, or I guess not pushed, but maybe not as well known as like a Schwab or a Fidelity. But just for the ease of the interface, would that be good to start with and then maybe transfer it somewhere elsewhere? And what's it like? Transfer an account, a Roth specifically?
Yeah. So I actually use M1 Finance, and it's one of my other ones. I actually really love M1 Finance. And I agree, it's not pushed a lot, and it's not pushed a lot mainly because it's like a more of a long-term investors type platform. You can't really like trade or like quick buy and sell different stocks as easy as you can in other platforms. So that's kind of why it's kind of pushed off to the side. But I really love it actually. I use it for my dividend portfolio, and I've been using it for over a year, and I really, really enjoy it. So I for me, I really like it. What it does with the pies, like you were mentioning, I think that's a really awesome feature. So as a lover of it, I'm gonna say yes because I do love it. But again, it's not for everybody. But and then when it comes to transferring, it's really easy. I don't know exactly on M1 Finance. I've never transferred out or to M1 Finance, so it might be a little different because some firms will transfer the fractional shares, some won't, some just sell it off and then give you that money that it costs to sell the fractional shares. So I don't know specifically with M1 Finance what it's like to trade transfer between brokerages, but I have done a Roth IRA transfer from different brokerages, and it's really simple. You just go to the new brokerage, you go in and you'll say you want to transfer an account. It'll ask you from what brokerage are you transferring from. You usually fill out the information on that page, and usually you'll have to like fill out some paperwork and either send it in, or sometimes you can do it online. It usually takes a couple weeks and it gets transferred over to your new brokerage.
Okay, cool. And I guess just you personally, if you don't mind answering, like, do you plan on holding yours there like long term?
Yeah, so I plan on holding my M1 Finance account for as long as, forever, essentially. And something to keep in mind with, so with these like smaller brokerages, this is off on a tangent, but I want to make this clear. I'll probably do a lesson on this, but since you guys are here, I'll give you guys a little sneak peek. But with these smaller brokerages like Webull, Robinhood's not as much anymore, but Webull, M1 Finance, I can't think of it off the top of my head, but like those two that are a little smaller, they're not like your Vanguards or your Fidelities that are massive. The problem that some people have with them is that since they're smaller, they can be more keen to going bankrupt or failing just because they don't have the massive like investors and they don't have the huge network that these big Fidelity E-Trades have.
Yeah.
Which is a fair reason, right? But with a lot of these, with majority of these brokerages, not all, but the ones that I've mentioned do have this, as well as many of them. But there's this thing that's called the SIPC. It's an insurance, essentially. Let me look up I don't want to say the acronym wrong. So it stands for wrong one. It stands for securities. Why is it? Well, it's not getting, but SIPC. What was it off the top of my head? Securities investor. Oh man, I'm blanking. But basically, what it is. One second. SIPC. Okay. Securities Investor Protection Corporation. But that's beyond the point. I kind of went off on a tangent there. But SIPC. So basically, when these brokerages open up, they can apply essentially to be covered by SIPC. And what that is if that firm fails and they go bankrupt, so essentially your stocks with that firm are bankrupt. Not really, but just to make it explain it easier. So the government will protect you up to $250,000. Let me get the numbers right. Up to $250,000. Well, so it's up to $500,000, which includes $250,000 in cash, up to $250,000 in cash. But basically, what that means is that if I'm using M1 Finance and I have, let's say I have $100,000 in there. 1 second. I'm just gonna mute you, Kendall, just real quick, because I think there's a little bit of echo.
Okay.
I don't know. It might not be from you, but so let's say that M1 Finance, I have $100,000 in M1 Finance and it fails, and my $100,000 are protected under SIPC because M1 Finance is protected under SIPC. So it's kind of like a backup to worrying about maybe your money is gonna if your money is within these smaller brokerages, smaller just compared to Vanguards, ones like that, your money's protected up to a certain limit with the SIPC. And the SIPC is nothing. It's just like if you went to a bank and they're FDIC insured. You might have seen that or heard that. FDIC. It's the same. It's basically the FDIC, but for stocks or for the stock market. So basically, that's kind of like a safety net, and it's nothing that you sign up for. So if you open an account at Vanguard, you're automatically, for no cost, you're automatically covered by SIPC because you're investing through Vanguard, because Vanguard's covered by SIPC. So with M1 Finance, I kind of went off on a tangent, but with M1 Finance, they're covered by it. So I feel comfortable at least having, that I'm nowhere close to that in my M1 Finance. But if I had 500,000, I would be comfortable because they're protected by the SIPC. Now, if I had $1 million, I might kind of be weary just because M1 Finance is smaller brokerage, but that's not a problem that I'm worried about right now. So I know I kind of gave you a really long-winded tangent answer there, but does that answer your question?
Yeah, definitely. I appreciate it. And then kind of going with that, do you keep your dividends in like a brokerage, like a taxable brokerage account there, or do you have that as like a separate portfolio in your Roth? How do you do that, if you don't mind me asking?
Yeah, so I do it in a taxable account. I know that some people, they're like, oh, why don't you hold your dividends in a Roth IRA and the tax shelter, which is a great thing and a great reason, a great like point. But for me, I just keep it in a taxable within M1 Finance. So it's just like a typical brokerage account, taxable account at M1 Finance. And that's where I have my dividends, and they just kind of drip and run through that way. So I don't keep it in a Roth IRA. And I know that that's not great for taxes, but I know that going into it. So I'm okay with it.
Okay, cool. I appreciate it. Thank you.
Yep. Thank you. Are there any more questions? Yeah, I will. I have some questions in the chat here. So there's a question about the Roth IRA. And if you take it out, they said you'll get penalized. Yeah. So if you can transfer Roth IRAs. Now you're at Navy Federal, so it might cost you to transfer out. Some places are kind of grimy like that, and they'll charge you fees to transfer it out, but usually like $50, $100, which sometimes you can even call in and get waived. But if you withdraw the money out of a Roth IRA, you'll get taxed on the earnings. But if you transfer it from Navy Federal to Vanguard, let's just say, for example, you won't get hit with any taxes. Like I said, there might be some fees involved, which you could call in and probably get waived possibly, or you could call Vanguard and they might even pay for it to because they want you to invest with them. But you shouldn't get penalized if you're transferring. You're not withdrawing the money. You're just transferring it from one tax shelter account to another. Now, if you penalized, like I said, you will get hit with that tax bill. Yeah, I will post the parameters in the Discord. I created research about 120. Kendall, I'll get to you in one second. I created and researched about 120 main stocks. So, if you're going to buy 120 dividend stocks, that's almost like that is too diversified. I would just go for like an index fund or an ETF at that point. I have 30 individual dividend stocks, which some people even say is too many, but I feel like that's diversified enough. But 120, that's way too many. If you're gonna do that many, I would just go for like a dividend focused ETF or index fund, or narrow that down by like a 9 or 10 divided by 9 or 10, where you have like 15 to 30. 120 is just way too many. And if you just buy one share of each of those, yeah, you have a lot of stocks, but they're not really worth anything other than one share. So it's better to have the ones you want and have more of them, so that the dividends you get and the compound you get from those accelerates even faster, rather than just having one share of 120. Because at that point you're just oversaturated in those 120. If that's the case, just go for ETF or an index fund. Kendall.
Hey, yeah. Sorry, I'm like taking over this.
No, you're fine. You're fine.
When you were talking about transferring accounts, can you like leave your stuff in your stocks and have all of it transferred where you don't have to rebuy things? Or does it have to be pulled out into cash and sold off before you transfer it?
Yeah. So most of the time, no. Like for example, when I did mine, I transferred what's called in kind, and basically what that means is you just transfer from what it is, like from Apple in here to Apple in there, or VTSAX in here to VTSAX in there, and so no, you don't have to sell off and rebuy. Sometimes, like I was kind of saying earlier, if you have fractional shares, some brokerages don't allow that, or they don't like that. So you might have to sell off that fraction. So if you own 15 and a half shares, you might have to sell off a half a share, but you won't have to sell off all 15 and a half.
Okay. And is that if you're just doing your whole portfolio, or can you like say, I want to switch these 5 stocks over to this account?
It'll be account, like you have to transfer the entire account.
Okay. Thanks.
Yep. Michael?
Yes. One more quick question for you.
Yeah. Yeah.
So you were talking about like the advantage of going to Vanguard. I think you mentioned it before, but just in terms of fees, are these fees like I guess for each individual like index fund?
So what I was mentioning was like sometimes, like the question I was asked was this person had a Roth IRA with Navy Federal.
Mhm.
Sometimes like transferring out of a brokerage, they'll try to catch you with a fee to transfer out, which
Right.
is like I was saying, kind of grimy of them to do. But they'll try to. So if you going to Vanguard, in particular, when I did it, I wasn't charged a fee. But if you are like going into Vanguard, a lot of times you can, or whatever brokerage you're going into, you can call and be like, look, I want to transfer my money here, but I don't want to pay the fee. And I've heard a lot of stories of people saying they just called in and asked like basically just kind of said what I said, and they're like, okay, we'll waive the fee. So the worst they can say is no, like, no, we're not going to waive it. Then, you kind of, okay, well, at least I asked type thing. But it just kind of depends on where it's coming from, where it's going. So, and you'll know, like, it'll say like, you got to pay $50 or whatever the fee price is, before you do it. So it's not like it sneaks up on you after the fact.
Got you. Got you. Also, you were talking a little bit earlier about TD Ameritrade for having opening up a Roth. Um, I was reading, I saw that TD Ameritrade and Schwab were merging. I don't know if you would know how that would affect like I don't know, fund or index fund choices, or like say if you went with TD Ameritrade, would you be able to get the Schwab?
Yeah.
Um,
Yeah. I don't know, on that particular question, if you're able, I mean, I would assume you will, if they're merging, they're becoming one, you should be, I would assume, now I'm just guessing, I'm not saying this is correct. I would assume you would be able to, since they're becoming one company, or, they're working together, essentially, I would assume you'd be able to, if you want, if you have a TD account now, after the
mhm.
merge, if you want a Schwab index fund where originally you have to pay a fee, but now since it's Schwab and TD together, I would assume it would be fee free. But I don't know for certain. I haven't seen anything on that, so I wouldn't. I don't want to say for certain that's the case.
Okay, thank you.
Yep. Thanks, Michael. Question to me: what would investing for 15 years aggressively look for you? So for me, I'm really aggressive into one ETF right now, QQQJ. If you follow me on Twitter or Instagram, it's like I always talk about it. But that's a pretty risky, aggressive investment just because it's the Nasdaq next gen, so it's stocks 101 to 200 largest on the Nasdaq. So basically they're a little more mid cap size stocks, so that's kind of aggressive for me, going into that. I don't feel comfortable hand picking growth stocks, um, compared to just rather putting it into ETF that kind of has a little bit of each and see where that goes. So that's kind of aggressive. I'll put the ticker in the chat. Rachel?
Hi, I wanted to know, okay, if you were looking for REIT, I guess REIT stocks, like
Mhm.
what will be your top 5?
1 second. Let me great question. So I don't honestly don't have 5 off the top of my head because I have 3 that I really like and I kind of stick with those 3. But I like O, so just the letter O, and these are the stock tickers. So O is Realty Income. They do more like rental houses, stuff like that. I like STAG, Stag. So they do more industrial parks, rental of industrial buildings. And then I like SPG, which Chris has talked about a lot as well. That's the malls. Those are the 3 that I really like for REITs. I do like. Well, excuse me. I don't own these, but I've seen a lot of people talk about them. But I haven't done much research. But a lot of people talk about it. Doesn't mean it's good, but it's just what I hear. Main, so MAIN, and Gain, GAIN. Those are 2. So that's 5, but those are 2 more that I've heard a lot of people talk about. So always do your research on all the ones we talk about. But those are 5 that, at least 3 that I know I like, and then the other 2 are ones that I've just heard a lot of noise about.
Thank you.
Yeah.
Also, when doing research to do your research, like what are the key things I should look out for? And of those 5 you mentioned, like, can I do them in a Roth or IRA?
Yeah, so you can do those in a Roth IRA if that's what. That's one as well, Sam. APTS. A lot of people talk about that as well. But yeah, you can do those in a Roth IRA. In a Roth IRA, you can own index funds, ETFs, or individual stocks, or a mixture of all 3, whatever you want to in the Roth IRA, whatever you want to pick. When it comes to researching them, I would just look at, what's the historical, again, history never can predict the future, but what's the historical outlook, or how has the stock looked in the past? So like, has it been growing? Has it been decreasing? Why has it been decreasing? Why is it growing? What's the future? Read up on the stock a little bit. Like, why do you think it will grow in the future? Are they, for a REIT, are they buying more land? Are they improving their current land or, buildings that they have now? So kind of just do your research and see, like, do I trust my money to be with this company, right? You put your money into a company, into a stock, because you believe in it and you want that stock to grow. So do you trust your money to be in that stock? Are they, if you look at their financials, are they earning positive revenue? Are they earning negative revenue? What's their profit? Why is their profit down? Is it because of COVID? Okay, that makes a little bit more sense. Or is it just down because it's been down the last 10 years? Well, then that kind of scares me. So kind of just looking at, like, whether or not you trust your money with that company. It's kind of the best way to put it, without like getting too in depth and spending hours about like what we could look at one by one. But that's just kind of an overarching, like, just ask yourself when you're doing your research, like, you're seeing this, is their financials green or are they red? What's the future outlook of the company? How's it been in the past? Why is it down? Why is it up? Do I trust my dollar or my dollars with this company?
Thank you.
Yep. Kendall, I'm gonna get this one question and then I'll get back to you. Any advice on having bonds in my Roth if I'm 34? So I'm not 34 right now, but when I am 34, I don't plan on holding any bonds either, especially in my Roth. That'll be something that I would do for personally. Now, my risk tolerance might be different from yours, but I'm pretty low risk, and I still don't plan to have bonds at 34. I think, yeah, they're safer than investments, but at 34, especially in a Roth that I don't plan to touch until I'm 60 at the minimum, then I'm not going bonds for, especially at 34, probably not until, in my late 50s, to be honest, just because, I'll play the risk of the stock market just to, over the long term, I'm going to play the risk like that. So at 34, for me, I'm not gonna tell you what to do, but for me, if I was 34, I would not have any bonds. Okay, Kendall.
When looking for like international ETFs, what would be like some good companies for them to have in like their top 10 or 15? Would it be like Tencent, like Chinese companies, or like what, I guess, international, like what countries or areas do you look for companies?
Yeah. So for me, the one I have is VTIAX, which I was kind of talking about earlier today. But yeah, so I'm looking at the holdings because I didn't know off the top of my head, but these are the top 10 holdings of VTIAX, which is the total international stock market. So you're looking at Tencent, like you mentioned, Alibaba, Samsung, Nestle, Toyota, Novartis, Taiwan Semiconductor Manufacturing Company. So, and these are, I mean, the largest holding is Tencent, which is 1.77% of the total fund. So, you know, like I said, I don't really know a lot about, even like me mentioning those. I don't know. I mean, I know some of those off, like, you know, I know Toyota and Samsung, but I don't know like Tencent, what their financials are. But the fund itself just is so diverse amongst the total international stock market that I'm not really like too worried about the companies more so than just like the entire. I mean, I am worried about the companies, but the overarching fund itself is just the total international stock market is more kind of what I'm getting at rather than just like Tencent in particular.
Okay, yeah, I mean, for that one specifically, I mean, their top holding is still less than 2%, so that makes sense. Okay, I'll look into it.
Right.
Thank you.
Yep. Are there any more questions here? We're sitting at an hour, so I'm gonna head off here. I'll take like a couple more. I'll do Sam and Kendall, and then we'll call it a day. So if you have any questions, you're still on here, and you aren't, and you want to get your question answered after the fact, or even next week, or heck, even next year, just send me a message on Twitter or Instagram at Decade Investor. That's where I am. That's where I am every day. So send me a message there if you have any questions. But okay, so Kendall put shells from the last time. So Sam will be the last question again. If you have any questions in the future, at Decade Investor.
Okay. So I think I asked this question in a chat before, and I just want to clarify. I have Fidelity for my Roth, and I have a couple different things that I'm in there, but the two main ones are FXAIX and then FZROX, the zero total market.
Mm-hmm.
So is that basically the same thing? Should I split those up somehow?
Let me,
because I think like from what
okay.
I think somebody told me that I'm basically invested in the same thing, but I was kind of confused about that because one is the 500 index and the other one is total market. So I know like the total market includes the 500 index, but aren't they still different?
Yeah. So what they were probably mentioning, and I ran into this as well. So you are correct in saying that FZROX includes the 500 companies
Mhm.
in the FX AIX.
Uh-huh.
But what they were probably trying to get at was that the S&P 500 stocks are probably a very large majority of FZROX. So essentially, you are taking and I'm trying to look here as I speak, so I'm losing my.
No, it's okay. It's okay.
Well, I'm trying to look up the top 10 holdings of each just to kind of show you.
Oh.
So okay, so the top 10 of the S&P 500 is 28% of the total assets, and then the top 10 of the FZROX, which are the same top 10, the same top 10, is 23%. So essentially very, very similar. And I actually, when I first opened my Roth, I ran into the same kind of dilemma because I had the Vanguard equivalents of total US stock market and the S&P 500. And I just settled with the, settled is a bad word. I enjoyed going to the total stock market just because it includes the S&P 500, but it also includes those growth stocks. Yeah, it's a very small portion, but at least you have them within, so for example, Tesla, right? Tesla wasn't in the S&P 500 until very recently. You wouldn't have been, if you had the FXAIX, you wouldn't have had the Tesla growth that you would have had in the FZROX. Yeah,
Oh, okay.
so yeah, it was a small percent, but you still had it within that. So I like the total market one, the total stock market, U.S. stock market.
Okay.
So if I can't tell you what to do, but if I was in
No,
your
I
shoes,
know.
yeah, if I was in your shoes, I would go to FZROX,
Okay.
just because you can have those smaller, again, it's not a huge percent of the fund, but you still get that allocation there.
Okay.
So that's kind of that's my thought, and where that person that was telling you was probably also coming from.
Okay. Yeah, that makes sense. It's just like, I guess I got confused because when you look at them, it seems like it's two different things. But when you really think about it, I guess that does make sense because one encompasses the other.
Yeah. And that's kind of where you kind of, yeah, it is. I mean, they have different, like you said, that they are different things. But since the S&P 500 is so large and those companies in there account for massive, a part of the economy, that's why they're a massive part of the total market one as well.
Okay. So would it be, I know you can't tell me what to do, but would it be wise to just kind of condense those two, or should I like move what I have in the 500 fund into something else, like more, I don't have anything international right now. Would it be wise to go put something in there too?
Yeah. So for me, I have 50% of I'm in Vanguard, but similar funds. I have 50% of my Vanguard funds in my Roth within the total U.S. stock market.
Okay.
And then I break up the other 50%, half into an international and the other half into like a tech focused one.
Okay. Oh, that's right. You did say that. Okay.
Yeah. And that's what I like. Maybe, maybe you don't like tech. Maybe you like, consumer staples or something. You could go into that, or, break it up however you want to break it. But personally, I have majority of my Roth in the total U.S. stock market, and then the other a little bit, one international and then one a little bit more sector specific in the tech.
Okay. Awesome. Thank you. That's so helpful. I appreciate it.
Yep. Thank you. Okay. Well, I said last one, but one more person raised their hand. Sorry if I pronounced this wrong. Dele. I'm sorry.
Okay.
I'm sorry.
Sorry, I didn't mean to raise my hand. I didn't hear the last question.
No, you're okay.
I just wanted to ask about buying into the ETFs. Is it the same process as waiting for a dip, or if it's something that's long term, like next 30 years or whatever, do you just buy it at the current price?
Yeah, great question. So what I do is I invest consistently every single week. But if there is a dip, if I am able to and I have a little extra cash on hand, I will put in more. So because I am holding for, like you said, long term, 10, 20, 30, 40 years, I just buy consistently each week. And if there's a dip, then if I'm able to, I buy more. If I can't, then I can't. But I'm still buying consistently every week. So I'm dollar cost averaging each week.
Okay. All right. Good to know. Thank you.
Yep. Okay. One more. I can't get away. No, it's okay. Nana.
Hi. Yes, Nana.
Hello.
Hi. My question for you is about your dividend investing. Do you do the drip method, or are you taking your dividends every month?
Yeah. So I'm dripping. So putting them right back in. Just because I don't need that money that they're paying the dividends, I'm just putting it right back in to buy more shares to get, the snowball going and bigger every single month and quarter. I know some people that like to let the dividend not drip and then put it back into different stocks that they want to put it in. But I like to just automate it. So whenever I get paid, it drips right back in, and, I don't even have to touch, move a finger essentially. And that's how I set up my drip.
Okay. Are you able to drip in, well, you said you do your dividend investing through M1 Finance, but if I have Fidelity, and I used to have M1, but can you drip in both of those?
Yeah, so you can in both. M1 Finance is a little bit different, but you can still drip. Fidelity, yeah, I have Fidelity and I have it set up to drip. So when whenever I get paid the dividend, the same, I get paid in, in the morning, and then that same morning it gets rebought at the whatever price, it just drips right back in. So
Okay.
yeah, it's just there. I would just Fidelity is a little tougher to find, but just Google like how to set up drip on Fidelity, and there's a YouTube video that walks you step by step, and that's what I used.
Okay. Why do you prefer M1 for your dividends versus Fidelity?
Yeah, just for me personally, because the way M1's Finance is set up, you can, what we were talking about earlier, you can set up pies, and within those pies, you can kind of set the percentages of the each stock within the portfolio, and it'll kind of automatically balance that. With Fidelity, they don't offer that. So if I put in $100, or let's say I put in $100 to buy 3 different shares, I have to put in 30, 30, 30, like manually do that. But with M1 Finance, it will automatically do it. Just that's the way that their software and their platform is built, which I really like. But that's just kind of what I prefer on mine.
Gotcha.
But doesn't mean Fidelity's bad or anything. I mean, I use Fidelity. I just prefer M1 Finance for that portion. But Fidelity, I love and use as well. So not trying to take any sides of the two.
Gotcha. Okay. Thank you.
Yep. Well, that'll be it, everybody. Thank you so much for being here. A good hour 10. Just some questions and answers. Like I said, if you have any questions in the future or tonight even, at Decade Investor is my social media, Instagram and Twitter. Send me a message. I'm on there every single day, sharing what I love to share. So check me out on there. But that'll be it. I don't know the next time I'm presenting, sometime in April. But you guys have a great and blessed night or day, wherever you are. And we will see you soon. I'll see you guys in the chats. I hang out mostly in dividends, index funds, and stock market beginners, but ping me anytime, tag me in a chat, and I'd love to come. If you guys do any trading, want to see you guys make that money. So you guys have a blessed night, and we'll talk to you all soon. Thank you.
Thank you.